Hey everyone, today I'm going to show you the simple guppy trading method that I've found and put my own twist on, and let's get to it. So what is the simple guppy trading? Basically, a man named Daryl Guppy came up with this idea of using 5 fast EMA lines and 5 slow EMA lines, and when the slow are below the fast, it means that you're bullish and going up, and when the fast is below the slow, it means you're bearish or going down. And then when everything is tangled together, that's when you look for entries, and then the stop losses are your exits. It's also known as the GMMA, which is the Guppy, multiple moving average. And it's also, there's an Investopedia link here if you want to check out more about this method. And then I'll put some links at the end about him and his trading. I think he's got a video as well that you can watch. So to know about the multiple moving averages, you first have to know what a simple EMA is, and that's the exponential moving average over the last amount of days. This is a 50-200 EMA, so there's two lines, and this is on the hourly. So basically when the lines cross is either when you sell or buy. So this right here, when the green crosses the red like this, that means you sell, and you get out, and you wait until the recross right here, and then you buy, and then you sell. This was just a failed attempt right here. You didn't lose too much here because it's buy and sell instantly, pretty much. And you wait, and then you buy down here. And then you don't do anything until it crosses again and you sell here. So you made profit this entire trade. And then you buy here, sell up here, and then you buy here, sell here. So it can, flatten out and stuff too. But basically, whenever they cross, that's when you buy, and whenever they cross the other way, that's when you sell. So the Guppy moving averages, there's multiple ones on TradingView, but basically it gives you a really clear and quick indication of if we're going up or down or if things are crossing. So with the one that I use here, it's called CM Guppy EMA, and this one uses multiple moving averages here, and then you can see there's multiple long-term ones as well. So using the same kind of EMA method of two lines, this one uses instead 10, 5 slows and 5 fasts, right? So when things are green, that's obviously, you're going up. It does a little twist and it turns gray, and that's when it's undecided and your stop losses start hitting, and then you don't do anything in this entire trade. Sometimes you can get a little fake out here, but you keep your stop losses tight, just kind of like how the quick in and out of that one EMA that we saw before. So you don't touch anything here, and you don't touch anything here, nothing here, nothing here. It turns gray. You start looking for entries, you start buying, you wait, and it starts taking off, and then you wait until it starts turning gray, and that's when your stop losses have moved up, and then that's when you sell, is when the stop losses trigger, and you keep waiting. So there's little ones here that you kind of, wait and wait a bit, go up and down a little bit, but the majority of it, like here, you can see the gray twist right before the big waterfall. Your stop losses would hit here, and you wouldn't be trading this. This is kind of a slower way of trading. It's not, for day trading or anything. This is on the hourly. This is the one that I like to use because it still gives you some time to react and some time to buy and sell and make some trades. So we avoid this entire place down here. Right down here, we wait for it to turn gray. Now it's green, and then we look for entries, we get in, and then we keep adding to it as it gets below here, and we move our stop loss up, 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 and then we get out up here. When it turns gray, our stop losses will hit, and then nothing, and then green, and then we buy a little bit more as every time it spikes through. Stop loss is hit because it turns gray here and turns red, instantly stop loss out, and that's how you trade it. And I'll quickly go through a quick trading that I did with this one actually. I used the Guppy for this last one, and I'll show you how it worked out. So you have to look for your entries and exits, right? So as soon as it turns green, you want to buy 20% of your trading stack instantly. And then you also have to worry about your stop loss because you don't want to risk too much, right? So it turns gray, you buy 20%. Let's say I have $10,000. I would buy $2,000 instantly because it can take off, right? You don't want to keep adding to your average to bring your weighted average up. You only want to bring your weighted average down. So I'll show you quickly in the next couple slides here. So continue to buy with the 80% of the remaining stack to bring your weighted average down. Your stop loss is still 1 to 3% of your trading stack, depending on how the market is. You maintain your stop loss going up. Move your stops every strike through the long-term EMAs, just one behind. I'll show you that. When gray, move the stop loss up to keep up with the sharp drops, and if it triggers, you wait until it makes a decision if it's green or red again, and if it's red, you saved yourself, and if it's green, you at least were safe. Alright, so just ignore this line. This is currently the price as I'm making this video. So basically, as this turns gray, like this has done right here, we look for an entry, and we look for our stop loss. So we wait for it to turn green. You can see it sliced through here, so we're still undecided. This is where our stop loss would be, so I put a red line there. So we wait, it turns green. I instantly buy 20% of the stack. So that means that out of my $10,000, I put 2 grand in as soon as I can see this green happening here. So I actually got around $8,000 as it was green. So we'll put that into the calculator, and this is what it'll look like. So instantly 20% of the stack. So my capital over here is $10,000 that I have. I want to risk 1%, right? My buy price was around $8,000. I put 8,000 because it's, a weighted average of that little buy that I had. So instantly 20%, $2,000 I stuck in. My stop loss is 7,600. We actually don't know our target price. So we're looking, around 10,000. This is kind of decided on where the market used to be, or, what everyone's kind of thing is, or if you have other indicators, that's also a factor. The target price doesn't really matter because we'll be moving our stop loss up as we go. So this is kind of unknown. So you can put kind of whatever you want that kind of gives you a bogus risk to reward. But basically, we want to worry about this risk, right? That we're risking only 1%. And it actually works out that $8,000, 7,600 is our stop loss. It says to use 2,000, 20% about, because we're going to lose $100 if everything goes south. So I was talking before to continue buying on the spikes, 20% of your stack, maintaining your stop loss and moving the stop loss to the last spike. So what this means in here is this was our stop loss because this was our spike. It turned green. We bought 20%, that 2 grand instantly. We waited, we didn't sell, we waited, and it came back through. Since it's still green, that is still an okay buy according to the Guppy. What we look for is our stop loss here. If it hits the stop loss, we only risked the 1% and we're okay. But if you buy the dip and you bring your weighted average down from 8,000 down here, and this was, I believe it was 76, it'll be in the next slide. But basically, you buy a little bit here, you add it to your weighted average to bring your weighted average down, you wait, and look, it went back up. It's still green, we're still okay. Goes up, comes back down, and it went straight through, okay? We buy a little bit more here to continue to bring that weighted average down, and our stop loss will actually be moved up to here, and I'll show that quickly. But basically, this is turned gray, so we're in an uncertainty area kind of thing. So this is kind of no man's land. We wait and we move our stop loss up. So as I was saying before in the slides, every time there's a spike through, we move our stop loss up. So right here we bought, it went up, it went down, we bought this dip, we move the stop loss up once it goes back through. So we move it to here, and we bought here, right? Went up, went down, sliced through, our stop loss is here, our weighted average is also coming towards the stop loss, right? We bought this dip, and you might not get the end, but you buy a little bit more as it kind of goes down. And then once it goes back up to the twist, which is currently happening, we move the stop loss up again. And at this point, our weighted average has been brought down so much that our stop loss and our weighted average are about the same. So just to give you a visual of what I was talking about there, we bought 2 grand worth at $8,000 instantly. Another 2 grand worth at 77.37, which is this dip. Another 2 grand at 78.67, which is this dip right here, and we maintained the stop loss as we went on. So we're in for a total of $6,000. Our weighted average is 7,866. Our stop loss is actually basically right on at 7,865. Now we're at a place of no risk and all reward. So pretty much everything from here on is very safe, right? We're not risking anything. So if you punch this into the calculator that was in my previous video, it starts looking a little weird and messy. It says that we should be in for $786,000. So obviously, the calculator is out of whack because basically our buy price and our stop loss is right here. And we want to risk 1% and we have $10,000, so everything's kind of getting out of whack. And you can see this risk to reward ratio is 21:34, which is quite high. And if we had this amount of money, that would have been cool too. So as we keep going here, We don't buy anymore because our weighted average is actually here, right? So we move up the stop. We're still going, we're green again, which is good. Move up the stop every spike through and it goes back, right? Move the stop up. And this one, you almost could get faked out here. It's a little iffy area. Personally, if it's a mental stop loss, just keep an eye on it rather than a hard stop loss. Keep moving it up every spike through. We didn't spike through, we didn't spike through. Moving stop loss up, we spiked through. Spike through. Spike through. We're not buying this entire way up, we're just riding our profits. Keep going up. Nothing, nothing, nothing. So right here, you can see it go up and then it starts going through. So it spiked through. So we move the stop loss up here and it goes up and it fails. And you can see the twist start, right? So when this twist starts, that means you're in serious trouble, right? If you're in green zone like here, and this is where you kind of use a more mental stop loss, is if you're still in the green so you don't get faked out. And right here you don't get, none of this is faked out. Once you start seeing some gray, you start getting worried, right? It made it up to it to retest it, and now it's failing. So our stop loss is here, we just let it activate. It activates, and we're out at, about 10,680. And then we don't touch anything because it's turning red, and we wait for a re-entry. So when do we get out? Well, we put 6 grand in total. Our weighted average was 7866 BTC USD price. Our stop loss hit at 10,688. Our total profit was 35.8% on 6 grand, which is $2,152. And that was from this trade. How long did that trade take? It was about 13 days, as you can see, when we got in to when we got out, and we just maintained the stop loss going up, and we didn't buy any more to bring that weighted average up because that would have started wrecking some profits. So in 13 days we made 35.8%, and as you can see, it was fairly simple. You just move your stop loss up. When things are green, you're good. When things are turning, the twist is turning gray, you start getting a little worried, and that's when you have your hard stop loss, and you basically make the exchange cancel you out and you move it up. And as you saw before, you keep moving it up, and when things turn gray again, that's when you just rely on that stop loss and you get out when it crosses. You can also watch it too if you want to do a mental stop loss. So that's basically it for the Guppy trading. I like to use it as a general indicator. I use other indicators as well, but it's pretty simple and easy to see, quickly on the charts here and there. If things are green, things are red. And yeah, that's pretty much it. Some further notes, this is the Guppy Traders website. This is where that Daryl Guppy, he has a trading group on there that goes through his method and everything. And then also watch this video, I'll put the link in the description. It kind of goes through his method and he talks about the stop losses and everything. He also talks about some other trading stuff that he's done. And that's basically it for this video. If you have any questions, comments, share, like, subscribe, and I'll keep posting some trading videos. Thanks.